Hey guys, Chris from Appropriation here, and in this video I'm going to show you the solution for question 7 from the Jan 2015 PoA Paper 2. If you want to see the solutions to the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the solution. So as per usual, we'll take a read of the information. So it says Sonja and John, or however you want to pronounce it, partners in the firm's Simple Solutions, discuss the incorporation of their business into a limited liability company. So first up it says, explain to the partners one difference between each of the following pairs of terms using one sentence for each pair of terms. Okay, the first pair of terms is authorized share capital and issued share capital. So let's keep it simple, shall we? So authorized share capital is the maximum amount of share capital that a company is legally permitted to issue or raise. Issued share capital is the amount of capital that the company has actually raised via selling shares. Next, preference shares and ordinary shares. So let's keep it simple. So a preference share has a fixed rate of dividend, no voting rights usually, and allows its holder to receive dividends before ordinary shareholders. All right. An ordinary share provides its holders with voting rights and also provides the opportunity to receive dividends, but bears the most risk of all shares. Now again, you guys could have very, very different phrasings or even different characteristics for each of these things. Please don't think that these are the only ways to phrase these answers. Okay, let's check out part B. All right, so it says outline 2 advantages to the partners of becoming a limited liability company. So again, let's keep it simple. So becoming a limited liability company would prevent the owner's personal assets from being at risk of being sold in the event of the company being liquidated. Liquidated means when you're selling off the assets of the company to pay off or discharge liabilities, and if the company's assets, the money they get for the assets when they sell it cannot cover the liabilities, the owner's personal assets have to be sold to pay the liabilities, right? So that's one benefit of going to a limited liability status. The owner's personal assets are not at stake of being sold, right? Also, they can also have access to a greater capital base as they can issue shares to investors who may pay a lot of money for them. So with partnerships, the amount of capital available is usually limited to just the partner's available savings or investment capital, whatever. With a limited liability company, if you are a public limited company, you can sell shares to the public at large. So you have a much larger potential capital base than if it was just a partnership. All right, let's take a look at part C to this question. Alrighty, so it says on 1 Jan 2015, the capital balances of Sonja and John were 89,700 and 95,300 respectively. So 89,700 to Sonja and 95,300 to John. Or if you want to say Sonia and John, whatever, again. So we have to draw up the journal entries, narratives included in the form provided below, to record the following decisions made by Sonja and John on 1 Jan 2014. Now, notice they say 1 Jan 2014 here, but 1 Jan 2015. So, bit of a misprint. All right, cool. Next, what do we do? Each partner purchased ordinary shares with a par value of $1 per share in Simple Solutions Company Limited using their closing capital balances. All right. And then John was issued 2,500 $2 debentures at an interest rate of 10%. John paid the amount due in cash. Okay, let's take one thing at a time. So each partner purchased ordinary shares with a par value of $1 per share. So each partner, Sonja and John, purchased their entire capital's worth of ordinary shares. So cash is going to get a total of 89,700 plus 95,300, which is 185,000. And ordinary share capital will be credited for 185. So again, with journal entries, as you can see, debit entries come first, credit entries come second, and credit entries are indented relative to the debit entries, all right? And the narration or narrative is that to record the issue of 185,000 ordinary shares of $1 par value each to Sonja and John for 89,700 and 95,300 respectively. So a narrative is to summarize what happened in the transaction. So it doesn't have to be overly complicated, but also don't make it too short where it doesn't actually give much information or sufficient information, right? So the next thing that happened here was that John was issued 2,500 $2 debentures at an interest rate of 10%, and he paid the amount due in cash. So if he paid this, so 2,500 $2 debentures, 2,500 by 2 is 5,000. So cash is going to increase by 5,000. And the debentures, so debentures is like a loan to a company, so it's a liability. And if it's increasing, you're going to have to credit the liability account, like so. And the narrative will simply say to record the issue of $2,500, $2, 10% debentures to John for cash. Now, a lot of people ask me, so what about the 10%? And I'll say, okay, what about it? Because this 10% is the interest rate. The interest rate only comes into play when the company has to pay interest expense. That is not what is happening now. The company is simply issuing the debentures. It's like it's borrowing money from John. Imagine you went to the bank and you borrowed money. You won't pay interest when you borrow the money. You'd pay interest later on, at some point, a month later, 6 months later, a year later. So the same thing. When companies issue debentures, they are essentially borrowing money. The interest will not be paid at that point in time. So please understand that the interest rate there is only for informational purposes that may have to be used in another part of the question. But when you are issuing debentures, the interest rate does not factor into the calculation. All right, we just have one more part of this question and we're going to call it a day. Okay, so for the final part of this question, it reads, on 31st December 2014, Simple Solutions Company Limited recorded a net income before debenture interest of $105,500. The board of directors agreed to the following. So we have to pay the debenture interest. Okay. We have to transfer $15,000 to a general reserve, and we have to pay dividends at a rate of 30% of the par value of the shares. And what do they want us to do? They want us to prepare the appropriation account for Simple Solutions Company Limited for the year ended 31st December 2014. All right, let's start at the top. So the first thing is the net income before debenture interest, $105,500. Now is when we subtract the debenture interest. So remember, it was $2,500, $2 debentures, which was $5,000 in total, at a 10% interest rate. 10% of $5,000 will give us $500. So we subtract the interest because it's an expense, and we're going to be left with a profit before appropriation of $105,000. The appropriations, we just have two things. So I think I put the dividends first. So you're going to see 30% of $185,000. That's because it says here, payment of dividends at the rate of 30% of the par value of the shares. The shares were issued at $1 each, and $1 was the par value. So it's 30% of that total value, which was $185,000. And then we also have to put in this transfer to general reserve. So let's put that, and we will add up those two things to give $70,500, which gives retained earnings carried forward of $34,500. Okay guys, so there you have it. If you have any further questions, please feel free to leave them in the comment section below, and I will try to get back to you as soon as I can. To check out more videos, click on these cards up here. Don't forget to subscribe and click the notification bell so you know every time I drop a new video. Check out my website for some free POA handouts, and in the description you'll find a link to my Facebook page for free solutions for POA maths and admaths. Guys, thanks so much for watching. I'll see you next time.